Welcome back, students who are taking financial accounting, and in this series of videos we were working on the assigned homework problems for chapter 7, which were the exercises for group B. Let's see here. Come on. There we go. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help you if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still do not understand the concepts, then either email or telephone an instructor to get help with that understanding. So all we have left in this series of exercises for Group B is problem 41. All right, let's see here. It says current ratio, quick ratio, current ratio, and accounts receivable turnover. Midwest Equipment reported the following items on July 31st. Amounts in thousands. All right, so the amounts are in thousands, with last year's amounts also given as needed. So here's the data. Compute Midwest Equipment's quick ratio, current ratio, and accounts receivable turnover for 2014. Evaluate each ratio as strong or weak. Assume Midwest Equipment sells on terms of net 30 days. Okay, so quick ratio, current ratio, and accounts receivable turnover. Remember, it's in the section focus on decision making. We have theory videos for chapter 7 on these ratios, and also if you need more explanation, go to the under the business group on the student community, under the business group, the section Math for Business / applications. There are theory videos that's like the last 1 or 2 chapters of the textbook were covering ratios, so I covered those theory videos there. If you're just picking and choosing videos here, realize that I don't go over the focus on decision making into great depth, because it was covered in depth in the Math for Business / applications section. Depending upon if you had Math for Business and Finance or Math Applications, it's in that section. All right, so I'm not going to spend a lot of time explaining it. I'm just going to work out the ratios. So our quick ratio, in this case here, right, is, let's see, what do we have for quick ratio? We have cash, accounts receivable, short-term investments, okay, and then we have other current assets, and then we have liability-wise, we have long-term, nope, we don't want long-term, we have current liabilities, and other current liabilities, and accounts payable, okay, so remember, for the quick ratio, right, we have basically our cash plus they're calling it short-term liabilities, I call it marketable securities, and our receivables, okay, and that's over our current liabilities. So when we're looking at cash here, we have 130,000, and then we look at our short-term investments, or our marketable securities, which are 95, and then we also have to add in our receivables. So our accounts receivable for 2014 is 280, and that's all over our current liabilities. But what are our current liabilities? We have accounts payable, which is 360, plus the other current liabilities of 25. Okay, so those are the figures we're going to use. So 130 plus 95 plus 280 is equal to 505. and that's over 385, and that divided by 385, so we end up with 1.31. Okay, so our quick ratio is 1.31. Now, for our current ratio, all right, we're taking the same thing, okay, but we're adding in. Let me erase this here. We're taking the same numbers, but remember the quick ratio is a subset of your current ratio. Your current ratio is your current assets over your current liabilities. So we're using these same exact numbers here, but we have to add in any additional amounts that are part of our current assets that weren't part of our current liabilities, and that would be the inventory here for 145, and let's see here, our other current assets over here for 65. So we're basically going to take the 130 plus 95 plus the 280, which is the same as what we use for our quick ratio, but we'll also have to add in the 145 and the 65, and that's going to be all over the same current liabilities of 360 plus 25. So let's do that. That was 505 plus 145 plus 65, or 715 over the 385. So divide by 385, and that gives me 1.85, 1.86 rounded up, 1.86. Okay, I'm going to erase all of this. So pause the video if you have to. And let's see here. Come on, there you go. Now for our accounts receivable turnover, remember the accounts receivable turnover was our net credit sales over our average net accounts receivable. Okay, so if you watch the theory videos, I went into great detail about what what net means and what average means, and all depends upon the information that you're given. Like in this case here, and if you don't understand how to calculate the net accounts receivable and then take the average of your beginning and ending, you're dead in the water. Okay, you're going to struggle with this. You have to understand the theory behind these terms as part of this ratio. All right, so go back and watch that the theory videos if you don't understand this ratio. If you're just going to watch me, I'm going to sit here and it's, I understand this, so I'm just going to be picking numbers here. And if you just follow along and you just pick the numbers without understanding that theory, right? And you see it's done, and this goes back to this very first slide that I had said, okay? Understand the concepts and apply to understanding. However, if you don't understand the concepts, that's a whole other thing. Watching a problem worked out will not help you if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos, and that's exactly where we're at right here. I'm going to work it out, but it's not going to help you if you don't understand the underlying concepts. So go back and watch those theory videos, and notice how I'm being a little bit adamant about this, okay? Because especially the denominator here, your average net receivable, is not as easy as picking out numbers. Okay. All right. So our net credit sales, they already gave us the net credit sales of 3,720, and remember this is in thousands. The amounts are in thousands. okay? And that's going to be divided by my average, all right, which is 280 plus 260, and that's all divided by 2. So I have 280 plus 260 divided by 2 is 270 over 3270. And so 3270 divided by 270 gives me 12.1. So I turn it over 12.1 times a year, right? Now, evaluate each ratio value as strong or weak, assuming Midwest sells on terms of net 30 days, right? All right. Go back and watch exercise 7-40, which I gave an explanation as to how we determine whether the quick ratio or the current ratio is strong or weak. All right. Briefly, if the ratio, the benchmark is 1.0. All right. If you have because you're talking about assets over liabilities, and yet you sell off your assets to pay your liabilities, if you have one asset over one liability, then you're at break even and you're in good shape. Anything greater means you're in really good shape. Anything lower, like if you had 0.5 in assets over and only had 1 in liability, then you're in bad shape because you cannot sell off your assets to pay your liabilities. So in this case here, our quick ratio here is strong, okay, and so is our current ratio. It is strong. And as far as our accounts receivable turnover, it's relatively good. All right. I mean, I'm just going to call that good. It's hard to say whether 12.1 is good or not. I mean, obviously it, because you kind of like want to compare it to something else. If it was only 2.0, then that's not so good. All right. So the higher the number, the better, right? The solution manual says the accounts receivable turnover ratio of 12.1 is good relative to the credit terms of net 30, right? Yes, I agree with that, but it's better for you to be able to try to compare it to itself. I mean, if again, you're sitting there saying, okay, you want a higher number to be turning over. Because that means you're collecting more on your accounts receivable. You have less bad debt. And of course, the lower it is, that means the more bad debt you're taking on. Right, so with that said, that's it for problem 7-41. If you didn't understand something, go back and watch the theory videos like I suggested. And if you still don't get it, then feel free to contact an instructor. And that's it for these exercises, so we'll be moving on to the problems in the next series of videos.